When even the Federal Reserve's uber-doves are talking up tighter monetary policy, you know an interest rate increase is already wrapped and in the mail. The hawkish chorus of Fed officials reached a crescendo on Wednesday when Fed Governor Lael Brainerd, one of the central bank's most cautious members, said that another rate increase would be appropriate soon. Now, Fed Chair Janet Yellen is due to speak on Friday, when investors will also be able to pore over another batch of employment data. But it now looks very hard for the Fed not to deliver its third interest rate increase since its tightening cycle began in 2015. Investors have been ratcheting up bets on the upcoming March meeting, with the market's implied odds of a rise rocketing from roughly a third this time last week to over 90% on Thursday. That is an astonishingly violent move in such a short period of time. That the Fed has managed to engineer this without upsetting financial markets is actually very encouraging. That implies that investors are finally beginning to break out of the central banking thrall. Moreover, investors now believe the Fed's plan to tighten monetary policy 3 times this year is actually feasible. Fed funds futures imply a greater than even chance of a hat trick of rate rises in 2017, and even a slender chance of more. And this is quite the turnaround. Investors have for years been skeptical of the Fed's more aggressive tightening path. And time and again, the US central bank has been forced to throw in the towel and moderate its guidance down to the market's views. Now, they're converging. But despite the euphoria in equity markets, bond markets remain skeptical that a new era of faster growth and higher rates is really dawning. Long-term derivatives that show what investors think the 10-year Treasury yield will be in a decade's time are trading at just 3.6%. The post-election rise has been fueled almost entirely by somewhat higher inflation expectations, not a change in fundamental expectations. And at some point, the divergence of views between the stock market and the bond market will have to be reconciled.